As someone who has been actively involved in trading for several years, I can attest that reacting to loss is one of the most challenging aspects of this endeavor. In this video, I will share my personal experiences and insights on the topic of reacting to loss, drawing from the valuable lessons taught to me by the financial markets. To truly appreciate the concept of reacting to loss, one must first understand the trading mindset. Traders need to cultivate a mindset that separates them from the crowd. This is not just about having a winning strategy, but also about having the right mental attitude. It's about acknowledging that losses are a natural part of trading and learning to respond to them in a way that enhances rather than hinders performance. I vividly remember my early days as a trader when each loss felt like a personal failure. My initial reaction was often a mixture of frustration, anger, and disappointment. These emotions clouded my judgment and led to impulsive decisions, which, in turn, resulted in more losses. It was a vicious cycle that many traders can relate to. One of the fundamental lessons which we should learn is understanding the probability factor. Every individual trade is essentially a random event with an uncertain outcome. It is crucial to internalize this concept because it shifts the perspective from expecting to win every trade to focusing on consistent execution and risk management. When I started to view trading through this lens, I realized that losses were not necessarily a reflection of my skill or knowledge. They were simply part of the probabilistic nature of the game. Reacting to loss became easier when I understood that a single loss did not define my abilities as a trader. Reacting to loss effectively requires embracing the uncertainty inherent in trading. I encourage traders to accept that they cannot control the market's movements or predict its future direction with absolute certainty. This acceptance liberates traders from the anxiety of trying to control the uncontrollable. I recall a particular trade where I had done extensive research, analyzed the charts, and felt extremely confident about the outcome. Yet, the market moved against me, resulting in a significant loss. In the past, I would have been devastated, but after internalizing on the lessons I had learned, I was able to accept the loss as a natural part of the process. This shift in mindset allowed me to move on from the loss more quickly and focus on the next trade. Discipline is an essential quality in the stock market. Traders should stick to their trading plans and follow their rules consistently. This discipline extends to reacting to loss. It's easy to succumb to emotions and deviate from the plan when a trade goes south, but this often leads to even greater losses. I have had my fair share of moments when I deviated from my trading plan due to emotional reactions to losses. Invariably, these deviations resulted in more significant losses, reinforcing the importance of discipline. Over time, I learned to stay true to my trading plan, even in the face of losses. This discipline not only preserved my capital but also improved my overall trading performance. Self-belief is a critical factor in reacting to loss. Traders must have unwavering confidence in their abilities and their trading strategies. Without self-belief, it becomes challenging to maintain discipline and avoid emotional reactions to losses. I can attest to the power of self-belief in trading. There were times when consecutive losses tested my confidence. However, by reminding myself of my past successes and the efficacy of my trading strategy, I was able to rebuild my self-belief. This, in turn, allowed me to approach losses with a more rational and less emotional mindset. Reacting to loss can be emotionally draining. I encourage traders to focus on the process rather than the outcome and to develop a detached attitude towards their trading results. Building emotional resilience has been an ongoing journey for me. I've learned to detach myself from the immediate emotional impact of a loss and view it as part of the long-term journey. This perspective shift has helped me stay composed during challenging times and maintain a rational approach to trading. Psychological capital refers to the mental resources that traders accumulate over time. These resources, such as self-discipline, self-confidence, and emotional resilience, are crucial for reacting to loss effectively. As I continued my trading journey, I recognized the importance of building psychological capital. It wasn't just about growing my account balance, it was also about strengthening my mental fortitude. Each loss became an opportunity to test and enhance my psychological capital, ultimately making me a more resilient and consistent trader. One of the most valuable lessons I've taken from the markets is the idea that losses are not failures but opportunities for learning and growth. I encourage traders to review their losses objectively, identify any mistakes or lapses in discipline, and use these insights to improve their trading. I started journaling my trades and reviewing my losses with a critical eye. This practice helped me pinpoint recurring patterns of mistakes and allowed me to make necessary adjustments to my strategy and approach. Over time, I found that my losses became less frequent and less severe, a testament to the power of learning from them. Reacting to loss in trading is a continuous process of self-improvement. It requires understanding the probabilistic nature of the market, embracing uncertainty, maintaining discipline, fostering self-belief, building emotional resilience, and constantly learning from mistakes. Ultimately, it's about cultivating a Zen-like approach that allows for a calm and rational response to the inevitable losses that every trader faces.